What's up, everybody? It is Brandon LeCaren here, and today we're talking about a super hot topic right now in real estate: secondary markets. I like to call them emerging markets, but secondary markets are really hot right now, not just for investors, but really for families, for people that are looking for better affordability. They're moving outside of major cities, and I call them emerging markets. They're generally sub-markets of major cities like Petersburg. I like to reference all the time, in Richmond. These are all great areas to invest. So I'm going to break down really what the major points to look out for as an investor, or if you're planning to move to a secondary market. Let us know in the comments, obviously. But yeah, let's break it down for you guys. So first of all, why secondary markets? Secondary markets is all about affordability. As mentioned before, the affordability in these areas are much less, so you can afford a nicer home with a bigger backyard, whatever you're looking for as a buyer or as an investor, and for a lesser cost of if you were to be buying closer into the city. The other thing too is that quality of life is actually better in these areas, and the reason for that is because there's less congestion in the areas, obviously, because you're not in the city anymore, and it's also a level of living costs less, right? So food is less, going to the store, again, less traffic, and everything costs a little bit less than if you were to be in a major city. So these are all factors to keep in mind and really to look out for as an investor to see what areas are popping up. Now, some of the top emerging secondary markets here are in the Midwest cities. So cities like Indianapolis, Kansas City, Raleigh, they're seeing a significant growth due to the affordability and the job opportunities that are moving there, which is the next point. So jobs are moving outside of these areas because they don't want people to have a terrible quality of life. So you're seeing companies kind of look at these markets and say, well, I can have the people that work here, have a great quality of life. It's going to cost me as a company less to even be in this market as well. And it's, the people are happier. So why not do this? Other areas are in the Sun Belt areas, right? So regions like Texas and Florida, they attract people because of the favorable weather, economic opportunities, and no income state tax. So obviously that plays a big factor in there. Some of the economic and demographic trends include population growth. So these secondary markets are experiencing rapid population growth, meaning, and naturally so, right? Because generally when you are a single guy or gal, you want to be in the city, you want to be where the spot is happening, everything's happening, and you just want to have access to everything. But as you become older and you want to grow a family, if that's your thing, you generally will move out to the suburbs. So really, they're seeing a massive population growth in these sub-markets, I call them, right? So the other thing, too, is the job market expansion, like I touched on earlier, is the job market is continuing to expand into these areas. So companies are also looking to move out into these areas, again, because they have to spend less on a building, and the people that already, want to work there, they're already there, right? So jumping into investment potential, let's see. Investment potential is the big thing here, right? So we're going to see higher returns. And the reason for that is because when you look at a sub-market, you don't have to pay for the congestion tax, I like to call it, right? You're not in the city, so your cap rate is going to be less in the city compared to when you go outside of that. Because the rent to value is a lot nicer when you get out of into those emerging markets. I love them a lot because then sometimes you can get it to 0.8% or 1% rule, especially if you're looking to cash flow in this high interest rate market. So if you're looking to cash flow in the high interest rate market, sub-markets, these are probably one of the best right now to invest in. Not to mention you're going to get the massive equity boost once the market catches up to it. So it's like you're getting in on the bottom level, on the ground level, and you're going to see exponential returns as soon as the market and everything else catches up with it. So the other thing too is obviously with these areas you're going to see lower entry costs. So again, you're not going to pay $500,000 for a 2-bedroom in the city, and $500,000 in a sub-market might get you a McMansion. So I would say, guys, make sure you're comparing hey, how much more can I get for rent if I bought a this type of house versus this townhouse versus a condo. I would generally stick to townhome or single family home in a sub-market because those are generally going to give you the best returns in my opinion. So the other thing too is market volatility, while growth potential is high, secondary markets can be more volatile. So that's why I say, kind of stick to the middle here. Stick to townhomes. That's why I love townhomes as investments, because people are either moving into them or moving out of them. Generally, first-time home buyers will look to buy them if you're looking to completely exit, that kind of thing. Also, do research on the infrastructure and what type of services they have. Don't go way out there and buy something with where they're not going to have running water for the next 10 years. I would say kind of stick right around the edge of the bubble as it's growing out, and then do that. And you'll notice that with those development. You'll notice that with new home builders. You'll start seeing them pop up. And you as an investor, always remember that you can move a lot faster than those guys can, because they have to go through permitting, they have to go through model home build out, sales team, infrastructure. So if you see a new development, generally that's a good sign of where things are going to go, and that they're going to have the proper infrastructure to handle those hundreds of homes or thousands of homes that they're building in those areas. So a couple case studies here are, so Indianapolis, a market position for a rebound 2024. It's increasing in activity. They're stabilizing, once mortgage rates start stabilizing, and it makes for an attractive option for both buyers and sellers. And I know that market. I know people investing there, and they're getting crazy returns. It's a great market, Indianapolis. Raleigh is also known for its tech kind of boom, and it's got a strong job market. So, look out for those areas. I highly recommend those areas. I know people personally that are investing in those areas, so you guys should look there too. Anyways, let me know what you guys think in the comments. Hit that subscribe button below, and I'll see you on the next one. Peace out.